Hey guys, it's Charlie Wessel with Cordell Capital. We have a presentation for you today for an investment opportunity. We're partnering up with Harvard Grace Capital and Stuart Heath on a 152,000 square foot storage facility near the Huntsville, Alabama market. All right, guys. Yeah, welcome to the presentation. This is some pictures of the storage unit facility that we are purchasing in June. Welcome to the presentation. So it's Grace Space Hazel Green Partners, Hazel Green, Alabama. Like I said, it's just outside of Huntsville, Alabama. 10 to 15 minutes from downtown Huntsville, which is one of the biggest populated areas in Alabama, as well as has some of the wealthiest zip codes in Alabama. We're offering preferred equity units up to 11,800,000, 8% preferred returns with recurring cash flow, 2024 bonus depreciation to help you out with the taxes on any other passive investments that you may have that you're currently, making money from. We're projecting a 1.87 equity multiple over a 5-year hold on this. These are going to be very conservative numbers that we're putting out in this presentation today. For more information, any questions, anything like that, you can contact me, Charlie Wessel. I'm the principal and founder of Cordell Capital. It's charlie@cordellcapital.com, or there's my cell phone number right below that. This is disclaimer. This is what the lawyers make us put in here. It says, we're not offering a security of any kind. Past performance is not indicative of future returns. It just goes through a lot of the legal stuff. And we will be sending this out in an email, this video, as well as this deck. So please read this, get advice from your CPA or attorney for any tax questions you may have or investment questions you may have. Investment highlights. Our purchase price is well below construction cost. We're kind of estimating it's about $3 million below construction cost. 2022 construction, it's only been in operation for 15 months. Which it's at a 25% occupancy level right now. Like the next line is, this is a turnaround opportunity. What it is the developer went and developed this storage unit and has no business running a storage unit business. So he has been really failing at a lot of aspects of running this business. Storage unit space is right behind it. There's a 900 house neighborhood that's just now coming out of the ground. I don't even think they have a third of the houses built right now. And to get to that neighborhood, they have to pass right by our storage facility to pull into the neighborhood. So also investors will get the bonus depreciation for 2024. That's, like I said, we do a cost segregation report on all property. Accelerates the depreciation on our properties. We're able to participate in that. All our investors we are to help out with our tax implications at the end of the year. Cash returns being after leased up, estimated to take 2 years. So it will take us 2 years. Like I said, it's at 25% occupancy right now. It's going to take an estimated 1 3/4 to 2 years to lease up to where we can start returning the cash flow back to investors. And that'll come in the form of quarterly distributions. We do have a projected 5-year 1.87 equity multiple. Specific investment is a 5 to 7 year hold on this property. All right, so asset class of storage is turnaround, lease up, refinance after 2 years, return a good bit of capital back to our investors, which makes this deal even sweeter, and operate for cash flow. All the lenders we've been in touch with, they know the business plan. They feel confident in the refinance of this property on the rates that they've given us is what we plugged into our pro forma. The manager is Harvard Grace Corporation. Stuart actually owns his own property management company. This is not his first storage unit in this area. And Stuart doesn't live far from these properties as well. They're all right around, Stuart, a 30-minute drive from your house, 40-minute drive from your house?
Yeah, the farthest one is 30 minutes from my house.
Yeah.
This one's 10 minutes from my house.
Right, yeah. So we have, boots on the ground for sure in the area. which is very important to us. And it just shows how we've stacked that with we're the owners, we're the property managers. We definitely have our thumb on top of all these properties, including this one. It's projected hold for a 5 to 7 year hold, 8% annual preferred return. It's an 8% annual preferred return to investor, return of capital investor. And after that, it's a 60% to investors, 40% to sponsor is the return for this particular opportunity. Quarterly cash flows begin when it allows. Like we said, we're projecting 2 years out is when we'll start distributions out there for our investors. Minimum investment is $50,000 on this. You do have to be a accredited investor as well. Just get with us if you need to find out if you're an accredited investor or not. We do, the easiest way to do that is to just contact your CPA or your lawyer and have them draft up a letter of accreditation. And I can send you an example of what one would look like if you need me to do that. Just shoot me an email. So tax treatment, we are maximizing the depreciation on this with a cost seg report. Investors will receive a K1 at the end of each year showing their losses on this property. And if you have other income coming in from other properties, then this will help offset those taxes on that for sure. Projected annual cash on cash is about 6+% after over 5 years after lease up. Like I said, guys, these are pretty conservative figures as well. We try to pad these quite a bit on the downside to maximize the return to our investors. Average annual return is 17+%. 5-year ROI is 1.87 or 187, which is a 1.87 equity multiple. Project name, Grace Space Hazel Green Partners LLC. This is the address where it's located. If you want to pull that up on Google Maps, you'll see this huge housing development that's going in right behind this place. I mean, they always say location, location, location. For real estate, this has got the location. This is a great opportunity. It's 570 units. That's a mix of conditioned space. We have non-conditioned space. We have boat and RV parking, where they can pull their things in. There's covered parking where they can put items. Current occupancy, like I said, it's at 25%. They just have not been doing a good job on promoting this property whatsoever. And, with the neighborhood being built currently right back behind it, this is going to be a great opportunity in this area. Lease type is month to month, but they will be put on the recurring payment schedule where we just draft out of their account or off their credit card every month. Nobody wants to get rid of grandma's furniture, guys. I have no idea why, but they sentimental value, they're going to hang on to this stuff forever. Management, like I said, is Harvard Grace Management. That's the company that Stuart owns. So, Stuart, I'm going to let you take it from here. You know a lot more about the area.
Great. Thank you, Charlie. Appreciate this opportunity. Charlie's a great partner. We've done another deal together and just really like working with him. Before I jump into the competition, just want to talk a little bit about the area. I wish I had a better map here. This is Google Maps, but here we are in the blue dot. I live just up here, just across the state line. This is Alabama, very close to the Tennessee state line. Huntsville itself is now the largest city in Alabama, and Madison County, where Huntsville is, will soon be the largest, most populated county in Alabama. They're saying by 2030. Birmingham is big and has been the biggest for a long time. It's not growing very much. Huntsville's been growing tremendously since 2008, and with a lot of factors. And you've got this great balance of government defense spending along with a good industrial concerns coming in, building plants. Toyota Mazda just opened up a year ago with a new engine manufacturing plant employing 5,000 people. And Facebook just announced last week that they're quadrupling the size of their data center there. And things like Jeff Bezos's rocket engine plant is located in Huntsville. It's just got this really dynamic community. And Hazel Green is now a suburb. It used to just be a bunch of farms, and you can see a bunch of farms in that map. I mean, it's now Hazel Green's time. Over the last 10 years, Huntsville has grown west towards two other cities, Athens and Decatur, and it's grown as far south as it can be, but the Tennessee River wraps through there, and so that becomes problematic. To the east, you have the tail end of the Appalachian Mountains, and so that becomes expensive building, and there's some of that going on. But this is the last great, nice, flat, easy building place to go to, and so it's Hazel Green's time. And there's another community in between Hazel Green and Huntsville called Meridianville, and it's pretty well fully saturated at this point as well. So when we talk about competition for storage, really we think competition is really only a 3-mile radius. So what you have here is essentially a 5-mile radius map, and we've identified all of the storage concerns, and I bullet pointed them there. The only one that I think is really comparable competition is number one, USA Storage, which is right here. Currently called 5-Star Storage. I don't know if y'all can see my mouse or not. I see Charlie in there. So the top one that you see there is USA Storage. They're a great national operator, very nice, clean facilities. It's gated, and they're 98% full. If they got no ability to compete, then they're really not competition, but they're a great competitor. All the rest of these, as you can see, I have listed poor quality, small facility. It is essentially smallish lots, less than 24 units, gravel lots, no gate, no lighting, no security. 5-Star Storage, or soon to be Gray Space Hazel Green, is a first-class facility, which you'll see through some of the pictures. High fencing, computerized gate, key code access, 64 security cameras, lots of lights. And when they built this thing, they did some good research, because we know your primary storage customer is a lady, and ladies value security and lighting after dark and things of that nature. So this is really built to be a state-of-the-art modern facility, and it's the only one for 15 miles. As Charlie's already mentioned, there is a neighborhood right there that's about halfway built up, where this neighborhood has to drive right by our facility to get back and forth to the main highway. This main highway you see right in the center of this picture is Highway 231 and 431 combined. This is a major trucking route. It's the major north-south thoroughfare that runs through Huntsville, Alabama, because Huntsville is about 30 minutes off of I-65, which is the closest interstate. So that's our competition. We feel like if we get in there and operate correctly, we won't have much competition. So our plan, Charlie's already hinted at this. We're going to acquire it. We're going to implement our turnaround plan. Our turnaround plan is essentially everything that needs to be done for any storage facility, which these guys are not doing. Aggressive introductory pricing. They are out there right now just saying, all right, here's our price. Every storage facility in the country uses introductory pricing. You either get the first month free, the last month free, the 6th month free, or you get a really low rate, and then once the promo has played out, you jack up the pricing to the current rates, and you're going to increase those rates anywhere from 1 to 3 times a year. On average, a 10% increase every year. And when you do that rapidly, what you're trying to do is, as quick as you can, find the customers that are sticky. Which ones are willing to move all of that stuff for $5 a month, and which ones are not? And 90% of them are not willing to move. They're not price conscious. And so that's what's behind the marketing plan. So introductory pricing, aggressive digital marketing. I'm not kidding when I say that the manager of this place told me, and when I asked him about his digital strategy, he said, and I quote, "I think Google is a fad." And I just gave him a slight grin. When I first found this property, you could not even find them on Google. So they're now starting to do a little bit, but it's half-hearted. I know from our other facilities that, and it's a fixed period of time until you get to your stabilization. You spend a fair amount of money on Google ads because people search for storage near them. That's their search term, storage near me, and then they find you. The other thing we've already added U-Haul to another facility of ours. We've already signed an agreement pending our acquisition to bring U-Haul to this site. The other one I'm doing is the hands-free, we don't touch it. It's a pickup and drop off location because U-Haul does almost everything through their app. This facility actually that has the office, we got 26 parking spaces inside the gate. This could become a major regional U-Haul facility. There is no capital cost involved in that. We will use some of our personnel, and the whole U-Haul model is they have different tiers of your compensation. So for the no touch that I'm doing in my other, we have a 21% commission on every transaction that takes place on our site. It's almost free money just by letting them park trucks there. If you go the full service route, which we're planning on doing here, you get to a 38% commission model. Plus there's goods and services and boxes, tapes, scissors, and all that we can sell them. And U-Haul has given us numbers from averages from their dealers that we've added into this pro forma. We believe at the 2-year point, we will achieve stabilized occupancy, which we define as 93% occupied. At that point, we will refinance. It's possible we could refinance before. 93% is our target. Most lenders consider stabilized to be 80%. But it's possibly we could refinance prior to that, depending upon market conditions. And then when we refinance, we'll pull out as much cash as we can. We send that back to our Class A investors, and then we keep operating this thing for cash flow with the aggressive continuing raising of prices, probably twice a year, maybe 3 times a year, depending on what the competition is like. At the opportune time, when we think we've achieved peak NOI, we would sell this. Also, depending on what the cap rate market is for valuing storage. Storage is hugely popular. I am not exaggerating with that. I get a call every week from for people wanting to buy one of our other facilities. And so these things are readily marketable. The lenders know this, which is why they're all willing to lend so much money against them. Let's look at our financial assumptions. We have a purchase price of $11,800,000. We have stated that's below construction costs, and I want to be completely clear. I do not know what the seller's construction cost is. This developer has owned this land for 20 years, and a half a mile away from this facility is a Walmart, and he sold the land to Walmart, and then everything that comes with that, he sold all these out parcels and stuff. When I say it's below construction cost, what I mean is if I were to buy that dirt today, the 8.5 acres, I'd have to pay $350,000 an acre. And then we know what the vertical cost of storage construction is. What we have calculated, and I've actually had contractors confirm this, if we had to buy that land for $350 an acre or even $300 an acre, it would cost us $13 million to build this facility. So somewhere between that and 12.5 or whatever, what it would cost anyone to rebuild this facility. I doubt the seller's looking at it that way because, like I say, he's had that land. He probably has a basis of $5,000 an acre in that land, and beyond that, all the other construction cost is the same for everybody. Our equity investment based upon that is $5,387,500. Now that assumes, and Charlie and I are complete agreement on this, we want to underpromise and overdeliver. This is our base case at which we expect to get a bridge loan at 12% to cover us the first 2 years, interest only 12%. And because this deal is a turnaround situation, we've got to raise extra capital to cover the cash shortfall for the first 2 years. Be very clear, there will be a cash shortfall for likely the first 2 years, or I think technically it's a year and 9 months. And then we'll refinance sometime in that eighth quarter of ownership. So a great deal of that in equity investment is reserves to carry the project. We're modeling that we will refinance the senior debt at 7% going forward, and that we'll get 30-year terms. Now, frankly, if this project was stabilized today, we could do better than 7% interest today. But I think this is a great way. We're not assuming that rates are dropping in the future, even though the financial media will tell you 10 times a day that they're going to start coming down this year. I am not convinced. 30-year amortization is fairly common for a storage facility. Our estimated 7-year equity multiple is 2.06. Charlie's already given you the 5-year equity multiple. So that's really only 3 years of stabilized operation when you get to 5 years. I do think that we should be thinking about a 7-year hold on this one, 5 years of operation, 2 years of lease up. But the property can be sold or refinanced or whatever at any time, at the opportune moment, anytime during that life. We'll talk about the 10-year just for a second. Probably pretty hard for y'all to see these numbers. It'll be clearer in the deck when Charlie sends that out. You see year 1 and year 2, no cash flow to the investors. You see our cash flow deficits, and you see our cash on hand trickling down. And then in year 2, we'll refinance, pulling out a couple of $1,000,000 at that point, which will come back to the investors. And we're still making money, and we'll keep making quarterly investments at that. We run it out 10 years just to show you how it progresses, because storage will have revenue increases every year, as you're going to have some cost increases and things like that. So what does this mean to the unit holder? Charlie's already indicated a minimum unit size is $50,000. So what does this look like for you over the first 5 years? So we got a big number there that we're computing cash on as the cash value of your depreciation deductions. What we will do, as we do in all of our projects, a cost segregation study. When we do this, the IRS allows us to take a portion of that $11,800,000 purchase price. We'll have to allocate that between land and building anyway, but a cost segregation study allows us to take a portion that's not land and reclassify that as shorter life personal property. And since the 2018 Tax Act, we've had this bonus depreciation, which up until 2022 was 100% per year. Last year it was 80%. In 2024, it's 60% bonus depreciation for your personal property that you put in service in that year. That means that the Class A unit holders will get an allocation of depreciation expense that you can use against your income, and how everybody uses it depends upon their own circumstances. So talk to your tax preparer on that. But we've already had our cost segregation provider give us an estimate, and so we're using his estimates, and so we're giving you the cash value of those depreciation deductions in year 1. Because it's only 60% deductible this year, we also will have a fair chunk of depreciable assets that will depreciate over years 2, 3, 4, and 5, because it's a shorter life. Real estate, commercial real estate is generally depreciated over a 31.5-year life. Residential real estate, 27.5-year life. Personal property, anywhere from 3, 5, or 7. And 5 is sort of the catch-all bucket where most of this will land. So you'll have higher regular depreciation deductions than you would have 2 years ago when we had 100% bonus depreciation. That's what's going on with the depreciation line. Year 2, at the end of year 2, we fully expect to do the cash out refi, and we would estimate, based upon our numbers, that each $50,000 unit will receive $21,521 in cash, and that will kick off the regular recurring distribution schedules, which starts in year 3 and later, and you see those grow over time as our rents continue to grow. For our purposes here, we've assumed a sale at the end of year 5, and then each unit would receive, call it $35,000 at the end of year 5, again, for modeling purposes here, which results in our expected ROI of 187.2%, or an equity multiple of 1.87. You can see my assumptions there at the bottom, and I'm happy to discuss that further. The next one gives the aerial view. I won't talk about a whole lot of these. So there you can see the neighborhood that's back off there in the upper right-hand corner. It's only about halfway built out. This area is still heavily under development without parcels still coming. This is a Culver's restaurant that's down here at the bottom corner. The first building you see, that is the climate controlled building. And then you see the larger units, and almost all of their occupancy has come from those back units with the blue doors and then the open coverage in the back. People who have big toys, those, you'll hear every storage operator say, I wish I had more big units. They always go first and they always stay a long time. You see the parking where there's the one camper there. That's where I anticipate putting U-Haul trucks in there. And then we have a very nice office in there to handle all of that. There's the gate.
This is the conditioned space right here.
Yes, that's right.
The large.
Very interesting instruction. They basically built that building over what was another building that looks just like the others outside. So it's a building within a building construction. One thing that's in our capital is we have allocated $50,000 for a very large sign. Right now, this facility is viewable from the highway, going both north and south. But a financial institution, large credit union, is about to build a branch that will block most of our highway. This is the county of Madison. Huntsville itself has a billboard moratorium, but we can come over here to the corner and we can put a very tall sign that will be seen above everybody. And so we will maintain that we get visibility and everybody's going to know we're there. And U-Haul will actually contribute to some of the cost of that sign. There's a picture of the office. So I guess one of the things I would be asking if I were is like, okay, what's wrong with this place? Why is it not doing very well? Let me just run down I already told you about their attitude towards digital ads, and I should have included a picture of their operating hours. These guys are not open on Saturdays and Sundays. We know that storage is a retail business, and most of the people who are going to use these other units, they're going to come Saturdays and Sundays, and that's when you're going to rent them. They use the same operating platform called Store Edge that controls the gates and bills your tenants and all that kind of stuff. It's one of the largest ones in the country. They use the same one, and they have all these features where people can find their unit and rent from you, while you're sleeping. They don't have any of that turned on. I don't get it. The other just sort of faux pas is 5-Star Storage is actually a brand of a national competitor. And so when I asked them if they had been received a cease and desist yet, they didn't know what I'm talking about. Now, there is no 5-Star Storage in this area, but they didn't even know that they had chosen the name of a competing brand. So I've talked about some of the other things. They're not doing aggressive pricing, but these guys are just they're just dirt developers. They thought storage would be a great idea, and they're right. They built a fabulous facility, but the people that have got running it don't know how to do that. They do an excellent job of keeping this place pristinely clean, which is also very important. So that's the inside of the temperature controlled unit.
Yeah, guys, that's about it. Here, I did want to share this real quick with you guys as well. Can you see that?
Excellent. Yes.
Okay. So this is the storage unit right here. This is our place right here. This is that major highway. Look at this entrance into the neighborhood here. I mean, they're going to have to drive right by it. And if you look at all these houses, all these neighborhoods that are being developed all over the place here. Some of them are these are all, you know, established neighborhoods here, and this is all the new stuff going in right here. Just over 900 houses. So it's a, you know, it's a pretty big
Yeah.
development going on in there.
Charlie, right at the top of your screen there, zoom back out. Yeah, right there by that, you can see the USA storage.
Right.
That's the only major competitor. Good operator, and they're close to being full. And they're kind of landlocked. Almost all of that farmland there to the east of the highway has been acquired by developers and will be becoming residential lots. Hazel Green right now has 1,300 approved, but not out of the ground units, single family home units.
This line here, that's the Tennessee, Alabama line.
Nope. Nope.
No,
Yeah, it's so from the top of this screen, we see Charity Lane. It's exactly 3 miles to the state line from there.
gotcha. All right, yeah. So, guys, this is a like I said, I mean, just a really nice storage unit investment opportunity. It's got really good returns, strong cash flow after 2 years. But you know, the upside on this is really big. So, anyways, yeah, I'm Charlie Wessel. Most of you know me. Some of you may not, or just meet me here. Yeah, I live in Charleston, South Carolina. Been married 23 years. You know, two twin daughters, 10 years old, and a 14-year-old son. That yeah, life's good, guys. Life's good. Um, you know, I've been here since 2005 here in the Charleston area. Anyways, yeah, please, guys, reach out to me. There's more information down at the last slide. You know, email address and phone number. As more than welcome to reach out with any questions you might have or anything like that. Stuart.
Thanks again, Charlie. I'm Stuart Heath. I'm the CEO and founder of Harvard Grace Capital and Harvard Grace Corporation. We do our when we bring a deal to market, we do the property management on everything, and we do that under the moniker of Harvard Grace Management, which is why you see all the different company names. Harvard Grace Capital has been around since 2020. I am a CPA who just fell in love with real estate and has been doing it for about 20 years. Harvard Grace Capital has about $20 million of assets under management in really just under 3 years. And like I said, we do things in the Tennessee Valley area, which is southern Middle Tennessee and northern Alabama, because that's our stomping ground and the area that we know the best. Known Charlie about 3 years, great partner. Really like doing business with him. The rest of the deck has slides for each of my other board members at Harvard Grace Capital, each of them with far more distinguished resumes than me, and just happy that they're coming along the ride with me. So anyway, and happy to answer anybody's questions about anything. So,
Yeah, if
thanks.
anybody has a question, you can either email me or unmute yourself, whatever you like to do. So we'll give it just a minute here for any questions. If anybody has any.
I have a question, Charlie
Yes, ma'am.
and Stuart. Have you guys also, I'm assuming that you have, but just asking, have you all also looked at what the competition, especially that one main one, what they're charging, and kind of work those numbers into what you guys plan on charging as well?
Yeah, our model is built down at the unit level, and we have based that up on market pricing. One of my partners in some other deals, let's just say he has an in with Public Storage, who has tremendous resources in market competition. So we're able to, on a limited basis, use their databases and to kind of tell us exactly where they think we should be on pricing. I'll say this right now, from a stabilized basis, 5-star is priced according to market. They're probably $5 a unit per month below USA Storage, and the broader market. But that doesn't get them in there. It's the aggressive marketing that gets them in there. So.
Yeah, and that's all part of our due diligence as well. I mean, when we do due diligence on places before we even, submit an LOI, I mean, we know the demographics, we know the average median income, we know how many cars pass by this place on a daily basis. So all that do what?
36,000 vehicles per day.
There you go. Yeah, I mean, all that we dig deep. I mean, we usually have 30 to 60 days to really deep dive into properties. And that goes for all properties, not just this one, but, any multifamily or strip mall or anything else that we're buying. We do a lot of due diligence.
And then after we invest and the project starts ramping up, how often will we be getting any sort of reports or updates or anything like that on how it's going?
On all of our properties, we issue a monthly report with financials. When we start distributing money, that will come out quarterly on calendar quarters. So that's January 15th, April 15th, July 15th, and October 15th. But every month you continue to get a report with financial operations, and we bullet point everything that's going on with the property, whether it's good, whether it's bad, if we're ahead of plan, behind plan, that kind of stuff.
Yeah, we know that, a rule of thumb in any industry and including in our households is that bad news doesn't age well. So we make sure we get all that stuff out there.
Yeah.
Charlie and Stuart, this is Keith. Just a quick question. I know you guys like to operate on the conservative side, and I greatly appreciate that. What is if we were to operate at kind of projections at above pace, and we get ahead of schedule, and we're leasing things faster, that neighborhood explodes in growth, and we're able to get ahead of schedule? Do you have any kind of projections on what that would look like if it does get ahead of schedule? Kind of what some maximum opportunities might be with this property?
I mean, we're actually underwriting this deal to a 5-year. We don't usually put all this stuff out there, but we're underwriting this deal to a 5-year ROI of 2.12 equity multiple. I mean, I just like to really go in conservative and really try to hit, like I said, we like to under promise and over deliver on properties if possible. And it's, that's kind of where we take our underwriting is we underwrite it. We still underwrite it conservatively, and then we drop them down from there. Just so that way, I mean, a 1.87 equity multiple over 5 years is still a really good return. We're still beating the pants off anybody at a, financial planning institution. So,
to specifically answer your question, Keith, I have not run the model, but if I think if anything is going to go better than the plan we've put forth, it'll be our absorption. It'll be our lease up could go significantly faster. There is data out there that suggests when you put U-Haul at a facility, you can accelerate your lease up by 30%. I have not modeled that here. We do have the ancillary income and the commissions that U-Haul suggested, and then I discounted that too, and it ramps up as well. But I think it's not unreasonable to assume that the lease up could go significantly faster than 2 years. Does that answer your question?
And there's other things that we projected a cap rate at sale higher than what we really think it's going to go at. Yeah. A higher refinance rate. I mean, we could get, like you said earlier, we could get, what was it, Stuart, like 6.25 or something like that?
I had one of the large local lenders saying, if we were stabilized today, our interest rate would be 6.75.
Yeah.
That's in the world where a lot of commercial banks are at 8.5, which 8.5 looks pretty good compared to 12. But I mean, this is really not a commercial bank kind of a deal. Because your year one debt service cash flow coverage is 0.5. So we're having to deal with non-commercial bank lenders, which is okay.
Yeah.
And sir,
And-
thanks. That did answer my question. That's what I was looking for. I thought
Right.
with some of the things you guys are doing, is it 20% higher, 30% higher? I think you answered that with the 30%. So I appreciate that.
Yeah, could be. Yeah, and yeah, U-Haul is big, and they're giving us averages too. And so one thing about averages, half of them are higher and half of them are lower. So again, that's what the data shows, and we did not choose to model using that particular acceleration data.
I have a quick question. What is the time frame for gathering the funds, for raising the funds for this deal? When does it close?
On the outside, we would like to close by June 30th. We
Okay.
would like to get commitments, in the next 2 weeks, and receive the investment funds first week of June, middle of June at the latest.
And I'll be putting out a soft commit form to everybody here that you can fill out and put the amount of money that you would like to invest into the deal. Like I said, our minimum is 50 grand. I know we have several people that invest quite a bit more than that with each deal, but that is our minimum. So yeah, you'll be getting that in an email here by tomorrow at the latest, with a copy of the recording, after I go back and record the first few slides that I didn't record. Kay, was your husband available to make it to the call today?
No, he's still away. He's in Boston, so I'm sure he will be listening to the recording.
Gotcha. Any other questions before we wrap it up? Well, guys, thanks so much for coming, and we hope you guys have a super blessed day. And like I said, reach out with any questions. Thanks so much.
Thank you, guys. Thanks
Thank
for your
you.
attention.
Thank you, guys.
All righty.